Well, good morning, everyone, and welcome to another FS Club webinar from here in London at 10 in the morning. And we have with us today a dear friend of mine, Djellil Bouzidi, who's dialing in from Spain. Today's topic, as you know, is patient capital, the key to rebalancing financial markets. You'll know me, I'm Michael Mainelli. I'm one of the directors of Zien, and it really is a delight to be able to chair these various FS Club webinars because they are absolutely fascinating, simply because our sponsors allow us to range widely and freely across technology, economics, and finance. So a warm thanks to all of them. And one of the things we're going to be talking about today, of course, is the importance of really sticking with the game and holding on to things and the benefits that that can give us. So I'm going to get out of your way in just a few moments. Then Djellil is going to speak for approximately 20 to 25 minutes, covering the ground of patient capital. We've got 15 to 20 minutes for questions and answers. And for a few fairly obvious questions, firstly, the slides are already posted on the site and will be available afterwards. The recording will go up in about 48 hours. And for the real questions that I'm asking you to provide so that Djellil and I can have a good discussion, please use the GoToWebinar chat facility. That allows you to feed questions in to me, and I will introduce them to Djellil. There's no point in emailing me. There's no point in texting me or WhatsApping me because I'm here with you, and I won't get those until later. So please do use the GoToWebinar chat facility to get cracking. And therefore, with no further ado, Djellil, the floor is very much yours. Djellil appears to have frozen.
Yeah, you hear me, Michael? I think it's okay now.
Good.
Okay, so first of all, thank you very much, Michael, for inviting me. I'm very happy to be here and share with you some few ideas. So today we'll be talking about patient capital, and we'll start with a poll, a quick one.
Okay.
So we can move to the next slide.
I'll get that cracking. So basically, today's poll is a straightforward one. What is the average holding period of stocks on the New York Stock Exchange? So I'm going to launch the poll right now. Got a lot of informed people in the audience, so Djellil and I were hoping for 100% answer on this one. People are very quick off the mark, Djellil. Over 3/4 of the audience have already voted.
Okay.
And I'll just give it another second or two for a few latecomers. And I'm now going to close the poll and show you the results. And as you can see, our audience is pretty well informed. Over to you, Djellil.
Yes, fantastic. Very interesting result. So we have around 60%, less than 1 year. But what is more interesting for me is that we have around the part of the audience, 26%, thinking that investment horizons are, between 3 to 5 years, or even more than 5 years for 4%. So maybe let's next.
Yeah, and absolutely no one was more than 8 years, which I think is interesting. Yeah. Anyway, here you go. Over to you again.
Yeah. So for those of you who answered 5 years, I think that you are in the 80s. So as you can see, in the 80s we had an average holding period of 5 years. In the 60s it was even more than that, around 8 years. But nowadays you are completely correct. The average holding period is less than 1 year. It's even few months on the New York Stock Exchange. But we have similar trends in Europe. Holding periods are around 5 months. So what we can see is that the capital markets time perspective is really shrinking. We have shrinking horizons. Those of you who are familiar, with the concept of portfolio turnover for asset managers, so meaning the percentage of portfolio holdings that are replaced in a 12-month in 1 year period is greater than 90%. I think it goes up to 136% to be more precise. For bond markets, it's not only an equity issue. The daily turnover is up to 20% higher than historical averages. And as you can imagine, this is a bad incentive for strategy, for long-term planning, long-term investments, and research and development. So we are clearly in a zone nowadays where capital is impatient, and when capital is impatient, this could lead to impatient business, and an impatient business also leads to a suboptimal or bad capital allocation. So let's see what's next. Yeah, so maybe this is an important paradox. I don't know if you had in the back of your mind all the figures, but we are in a world which is completely awash in money and liquidity. So as you can see in the figures, the one on the left, global liquidity in percentages of world GDP is around 200%. So it's twice, the amount of global GDP at something around, 180 trillion dollars. So it's huge. And I think that this, let's call it cash paradox, illustrates, the preference of the present versus future generations. And we are in a completely, original and yet intriguing situation, maybe connected also to the fact that there is not enough private investment to absorb all the private savings, as we will see it, in the next slide. So what has been called, by some economists and experts like Larry Summers, secular stagnation, is exactly the situation. So there is not enough private investment to absorb all the private savings. So this is the key of the problem. It's a problem of transformation of savings into investments, and it's characterized by an environment with extremely low interest rates. So as you can see in the figure, OECD 10-year government bond average was 4%, around 4% in 2008, and now it's fallen, below 1%. It's around 0.8%. And as you know, some governments, Germany, France, and many other governments are even experiencing negative interest rates. So we have also an inflation that is at very low levels in developed countries. And some are thinking that this will probably lead to weak demand, low growth in inflation, and it could be a new normal. So the question is, what is the impact of this very, very low interest rate context on patient capital? Is it good or bad for patient capital? And what we can see is that given the risk premiums that are very high and the return on equity and return on capital that are still very high, it's not necessarily a good news for patient capital, because as we mentioned, we have a problem of transformation of savings into investment. So in parallel to that, and that is also an interesting, let's say paradox, there's global shortage of long-term investment of patient capital, even if we have, huge needs to face long-term challenges. I'm mentioning here World Economic Forum paper of 2011, so it's quite old now, but I think that it's still completely up to date, called The Future of Long-Term Investing. So even what is interesting is that even for long-term investors, as pension funds, sovereign funds, family offices, we have such important liability constraints to fund short-term commitments, and also strong regulatory and maybe accounting constraints, that even for long-term investments, we have less than 25% of the assets managed by those asset owners that are really long-term. So you can imagine, with other actors. And meanwhile, we have huge needs. If we take only one big problem, and that is a long-term problem, which is the fight, against climate change, you can see that the volume of investments needed, additional annual, averages to limit global warming to 1.5 degrees Celsius by the end of the century, we will need between 150 billion additional investments up to 1.7 trillion. So you can see that the estimations are quite different, but the amounts are still huge, and the total investments needed to transition to a low carbon energy are also huge, ranging from 0.8 trillion to 2.9 trillion dollars. So it's an intriguing and interesting paradox. So let's see what we have next. Yeah, here I'm just asking, a provocative question. We see that we have this paradox, we have issue of and problems of transformation of savings into, investments. But is this patient and long-term capital the panacea and the solution for all long-term problems. So we have some critics, and it's quite natural, who are opposing the idea and saying patient capital is necessarily linked to lower performance. Others are saying short-termism is a catch-all complaint against capital markets and large public company, and sometimes impatient capital is not linked to shareholders, but to CEOs, and also that there is no empirical evidence supporting the claim that managerial short-termism leads or to less innovation efforts and less research and development. But what we can already answer, even if those critiques are sometimes completely accurate, is that the absence of engagement in pursuit of short-term performance is a necessary condition, for a higher level of patience. That's true, but you can have, a focus on creditworthiness instead of share price performance, okay, and that you can generate performance on the long term, and that it's better. I spoke, to some private equity investors, and they told me we prefer, thinking about net present value instead of internal rate of return, IRR, or return on equity or return on capital. Why? Because if you think, on a long-term horizon of 20 to 30 years, having a net present value that is really high on this horizon is better than a 12 to 15% return on equity on less than a year. And the key is not, to accept to sacrifice performance for nothing, but if your assets are well managed and if your choices are made well, patient capital could be and will be a good bet and generate a higher performance. Okay, so liquid and long-term, well-managed assets generally, could bring you a higher performance. And the answers to the critics of linked to the horizon of CEOs instead of shareholders, I think quite correct. The answer to that is a theory of Philippe Zimbardo, which is a psychologist, U.S. psychologist who built a framework called time perspective theory. Okay, so time perspective of shareholders and of CEOs is key because behind patient capital or financial capital, you have financial actors that could be individuals, that could be institutional investors, and you also have structures, with shareholders, CEOs that could have different time perspective. And what is interesting is that several studies show that there is a strong link between time perspective of shareholders, managers, and also the performance of a firm. So we can move to next slide. Yeah, so here I wrote, that impatient capital for me is driven and maybe mainly driven by this time perspective theory. So what is it? Time perspective for individuals. You can run the test if you're interested. You can go on the web and find a quick test with 60 questions, and it will tell you if you are past-oriented, present-oriented, or future-oriented. Okay, so we will not go into the details except if you have questions about this, but generally you can be past, positive or negative, you can be present, hedonistic or present fatalistic, or you can be future positive and negative. So I mentioned also, in the bubble in red, that you have for sure several other drivers that could influence your time perspective and financial actors, and that could bring you to more impatient capital territories, which are fiduciary duties, investor mandates, investor beliefs, tax treatment, prudential regulation, accounting norms, and these are really important, monetary policy, especially in nowadays context, and also performance metrics. So let's not forget all these important drivers, but I think that you can materialize them in this patience or impatience, of institutions and of individuals. So we have an illustration next. This is a funny study. So I mentioned it. Those are psychologists who studied, the potential link between the future orientation, the future focus, or the past focus, of nations. Thanks, to search engine, and they use search engine query data. And what they found is very interesting, result is that, as you can see, there is a strong correlation between future focus and per capita GDP growth. And if I remember well, the results of the study is that you have, Germany and Switzerland ranking very high on the future focus topics. And you have also other studies, mentioning that the German language, the way it's built is can drive German people or German speakers toward a more future focus. And you can see also a negative correlation if it's not completely perfect between the past focus and a lower GDP per capita. So time perspective is important. Let's see what we have next. So yeah, here I draw a first list. As I mentioned, behind patient capital, you have patient capital providers, you have financial actors, and as you can imagine, patient capital requires long time frames, but also engagement, that is really important, and support for prioritizing long-term over short-term gains. So you have classic asset owners, which can be driven by the nature of their liabilities and be natural long-term investors and providers of long-term patient capital. So you have sovereign wealth funds, important actors, pension funds, insurance companies, family offices. But don't forget that these guys will have to invest in hedge funds, active or passive index investors. They can invest also in venture capital. They can invest in private equity. And private equity is an interesting example because you have what I call the corporate governance paradox, because they are clearly targeting highest share price with exit and clear exit strategies, but with relatively long holding periods because they're not less than 1 year. Private equity is generally between 5 to 7 years, maybe from time to time more. So you can see that patience is a continuum, and you have some temporal complexity. It's not an easy question. You can be patient and engage. I think it's the better, the best, possible configuration and framework. You can be loyal or not, and you can have a good future-focused time perspective. But the questions that you have to ask is, and to keep in mind that engagement is an important concept to be coupled with long-term focus. You have to maybe also ask yourself if your investors or lenders will exit if you have bad short-term performance, and this is also linked to the important concept of risk appetite and risk tolerance. Even if you have I don't know, a sovereign fund invested in your company, what will he do if you have I don't know, 20 to 25% crash in your stock price? Will he still be loyal and engaged, or do you have any problem with risk tolerance and limit at those levels that will make him go out? So this is an important question. Let's see what we have next. So now we move maybe to a more interesting part, after what the definition of the issue and the problem, that is we have more and more impatient capital. So maybe an interesting question is, what could we do about it? So I pushed several recommendations, especially with Michael. So I ranked them, in asset class innovation. So we will do a focus on sustainability linked or policy performance bonds. We will talk about those. We could also have prudential innovation, as I'm sure you are aware, of the debate regarding green supporting factor or brown penalizing factor. So must we use central banks and risk-weighted assets to drive financial institutions investments toward green investments, for example? We have also debate linked to green collateral. I think that accounting norms are very important. I will also talk maybe quickly about green discounting, and finally you have legal and institutional innovations. So we'll have not the time to run into all details, but if you have questions, feel free, and I will give you also my contact details. So if you want to chat or discuss about these ideas, I would be more than happy to discuss. Maybe what is interesting, so the last one is the long-term stock exchange. It's not my idea. Other ones are I either pushed or ideas where I contributed actively, but this one is supported by Eric Rice, who wrote a lean startup. I don't know if you are aware. So he created basically a stock exchange focused on the long term. Currently they don't have, because it's quite new, listed corporates. They offer a dual listing, but I think that we will probably have in the few days big companies like Airbnb that could be also listed on this long-term stock exchange. So let's focus on the first idea linked to asset class innovation. So you can hear a lot of different names. Some guys call them, Michael and I, policy performance bonds, environmental policy performance bonds, or sustainability linked bonds. So we first propose the use of such instruments more than 10 years ago. We wrote different papers and also a book with Michael. I'm sorry, it's in French, linked to this green financial innovation. So what do we have? We have several different ESG bond flavors, as I'm sure you're aware. We have classic green bonds that claim proceeds will be applied to green projects with a fixed interest rates, as you know. We have sustainability or ESG bonds that claim proceeds will be used for wider ESG goals. We also have the third category, sustainability or ESG bonds, where the issuer will report directly on targets, like the Alphabet recent issue. And finally, you have policy performance bonds. And here, I think the innovation is that you link financial to environmental incentives, meaning that the interest rate is not fixed, like in a classic green bond, but is really linked to an achievement. And recently, you have the ECB. We talked about green collateral, that accepted such instruments as a collateral. So that is a very good news. So maybe we can move to the next slide and focus on recent examples. So you have Energy, which is an American-US energy company who issued recently 900 million in senior notes as a sustainability-linked bonds. And the main feature is that those are, as we say, pay-for-failure bonds, meaning that Energy targets an absolute greenhouse emission of 31.7 million metric tons of carbon dioxide equivalent by the end of 2025. So they say basically to the markets, we will reduce by this amount, the absolute amount of our CO2 emissions compared to 37 millions, in 2019. And if we fail, we will pay you 25 BPs more. Okay, so what is interesting maybe is what their senior vice president and treasurer said, as you can read. I think that for many companies and many investors, especially investors, there's some skepticism about what companies will do, even though there are some big announcements. They will not necessarily do what they planned. So I think that it could allow companies, especially those who are in a transition and that are not necessarily pure players, green pure players. So this allowed them, to maybe reach new type of investors. And what is interesting is that the demand for example, this type of bond, energy bond, has been mainly driven by investment grade investors. And as you can read, they committed, to disclose the actual financial impact in the bond documentation for each, issuance. And there is a 25 BP coupon step up. And if you're asking yourself about how will we check this, so basically the KPIs will be externally verified on an annual basis, and the bonds, contrary to a classic green bond, will be used for general corporate purpose. So you don't have to tie the proceeds to green projects. And then we have another, even more recent 2021 example that took place in Asia. So we have this Hong Kong property developer, NWD, New World Development, who issued, one of the first interesting sustainability-linked bonds, and I will tell you why. They committed to 100% of renewable energy for their rental properties by 2026 in the Greater Bay Area, okay, and in the US. So the proceeds, as in the previous example, will not be used for green projects, but for general purposes. But what is interesting is that they're committing to use the 25 basis points per annum if they failed to achieve this objective, to buy carbon offsets. Okay, so they will not pay investors, but they commit to buy carbon offsets to help them achieve this objective. So in the case of a sovereign that could issue such sustainability-linked bonds, and I know that nowadays you have some discussions because we don't yet have sovereigns that entered into these new structures. But some investors could be maybe concerned by being short of the environmental performance of a government. So maybe governments could also, if they fail, instead of paying investors, maybe buy some carbon offsets. And then next slide. Finally, we have another idea linked to accounting. Okay, so this is maybe a little bit more intriguing and complex, but imagine that we have a lot of sustainability-linked bonds, especially sovereign sustainability-linked bonds. Here, the idea is to say that discounting, as you know, is very important, is king, because when you compute net present value, for a period of 20 to 30 years, as you know, a very small difference in some few basis points in the discounting factor that you use could lead to big and very big differences in the net present value. And generally, when you compute this discounting factor, you use the risk-free rate, of the government where the project is taking place. You generally also use some credit spread, maybe some liquidity spread, and that's it. So my idea here is to use a climate premium that could be calibrated, depending on the CO2 footprint of a specific project. For example, if you have a very big footprint, you can add a 50 to 100 basis point, climate premium in your discounting. If it's a renewable energy, natural, CO2 natural project, you can take a zero premium. And if you do some carbon capture, you could even take a negative climate premium. And this could, lead to very, very huge differences. So the main objective of this slide is to spur, the debate and to say that accounting and discount factors that are almost forgotten, in the analysis could be also very powerful to push us, drive us to a more sustainable world. So we can move to next slide, but I think that yes, here you have my contact details, so I'll be more than happy to answer if we don't have the time, in the span of this webinar to continue discussion with you.
Djellil, that was super. We've got quite a few questions and comments here, so to get going. I was just going to ask you, could you just emphasize that point again, that one of the great things about these sustainability-linked or policy performance bonds is that the proceeds are not hypothecated. Is that correct?
Yes, absolutely, absolutely. Proceeds are not hypothecated. You commit yourself toward a scientific and environmental objective. So let's say that you take your NDC engagement if you are a government, and you say, okay, basically, I said to everybody, in COP21 that I will reduce by 10% my CO2 emissions. Now I will commit that if I don't achieve this target, I will pay you a little bit more, for example, 25 basis points or 50 basis points. But then, as you commit, to a scientific and measurable target, you can do whatever you want with the proceeds, with the money. Your only constraint, is to respect your objective. The difference with green bonds is that you commit to the use of proceeds. If you default on your green promise, generally nothing happens, because you don't have a covenant saying that if you fail on your green promise, you will have to pay some basis points. And you also have greater, reporting costs, because you have to link and to measure and show what you did with the money. And it's not the case with the policy performance bonds or sustainability linked bonds. You are absolutely correct, but you are behind this idea even more than me, Michael.
One of our regular viewers, Elizabeth, is curious. You opened with a question on equity retention and holdings, but you've focused on debt instruments. Are there any comparable equity approaches?
What do you mean? I didn't get the
you opened with a poll on shares and equity, and what you've spoken about has mostly been about debt. Are there equity approaches to patient capital?
Oh yeah, sure. Because it's sorry about the confusion, but it's true that lenders could provide patient capital, for example, banks. But as you know, they are more focused on credit worthiness and less, about risk taking, and it's quite let's say usual. But with Basel III, as you know, and all the prudential regulation, they are pushed, towards less and less risk. So they went out, for example, and they sold, their private equity departments and stuff like this. But I think that equity is more important for patient capital, because you can build, interesting and innovative companies like Tesla thanks to equity, not to banking loans. Even if banking loans on the long term are important, but as you know, you have greater risk, a risk sharing mechanism when you go, into equity investments. So I didn't mention it, but pension funds are important. I think that pension funds in the UK are not an issue. But if you take France, that I know quite well, we don't have pension funds. We have very, very, very small pension funds. So we don't have long-term investors that could invest enough in equity. So that is a very big issue. That's why you have, some sovereign funds also that are investing also in countries like France. And I know that the big companies are really interested by having these investors because they know that they are more patient. So the big companies are keen to attract, such sovereign funds. And equity investment is key, maybe much more than that. So I'm sorry if this point was not very clear in the presentation.
Okay. And Hugo Innes would like to continue along those lines. What are the positive incentives for equity investments that are patient?
Yes, the positive incentives, as I mentioned, are in if you are patient and if you can accept, to take this illiquidity risk, you will have an illiquidity premium. I discussed with an equity infrastructure investor a few days ago to prepare this presentation, and he told me, we look more at net present value, and our horizon is 25 to 30 years, and we know by doing this. Because we also are very, engaged on our projects, and we try to manage very well our assets. And thanks to our engagement, we know that a positive net present value on 25 to 30 years will be less, will be much more, interesting, even if you only take the return on capital or return on equity measures than the classic, return on equity of let's say 12% on 1 year. So the positive aspect of this is that if you are patient and if you manage well and if you are engaged, also it's very important. You can capture this illiquidity premium and you can have greater returns, but you have to be risk tolerant. You have to calibrate a risk appetite statement or risk appetite framework, by telling, okay, I can accept up to, I don't know, 20% or 30%, depend on the company, on the investor, on the asset owner, of loss a year. And if I have this loss, I will go out. So.
Some interesting comments here. Peter Cousin wonders, should governments be encouraging long-term investing? For example, by reinstating taper relief on capital gains?
I think so. I published a paper, and as I mentioned, it's an issue. It's more of an issue in France than in the UK because we are in a deep lack of long-term investors. So we pushed some ideas. For example, is to have and I know that it's quite. Open to debate. A lot of guys are not okay with this, but for me, for example, an ex ante, not an ex post, an ex ante engagement, to let's say hold your equity investment for a certain period, for example, 2 years. So you invest in a company and you say, okay, I will stay 2 years. Okay, then you can have more voting rights. Okay. Now in France we have an ex post. So if you stay 2 years and we see that you stay 2 years, we will give you twice, the amount of voting rights. What I'm saying here is that we can put it ex ante, and if you engage, as an investor and to stay at least 2 years, and then you will maybe detail some opt out or exit conditions, then you can have immediately more voting rights. Why not? And another idea. Is to help also individuals, not institutional investors, to have some, and maybe this is quite technical, but to have some the equivalent of repo, repurchase agreements, and to allow you to sell your voting right, because generally when you are diluted, you're not really engaged. If you have 0.0001%, of, for example, BNP Paribas in France, what's the interest? What's the point for you to go to the General Assembly and to engage with managers and to try to influence them? So maybe the idea is for you to extract the value of your voting right, to give it to a specific company, why not a proxy? And the counterpart of that is that they will give you some money. And what is interesting is that the value of this voting right is not zero, far from that, as some big technology companies understood. And I think that by doing this and extracting some money from your voting right, you can encourage more long-term investments. Other ideas are to create more sovereign funds, maybe at the European level, at country level. It could be interesting also.
Bob McDowell comments, you might want to respond to him. Would limited forms of capital controls, which deters short-term investment, help address the problem?
What do you mean by limited forms of capital controls?
Exactly. The ability to realize capital that's exported from the country, for example.
Oh, yeah. I'm not a big fan. I see what you mean, but we have the debate currently in France with Couche-Tard. I don't know if you know Couche-Tard, which is a Canadian company who suggested to buy and is trying to buy Carrefour, which is the equivalent of Walmart in the US. So we have the economy minister, Bruno Le Maire, who said even before having a look at the file, it's a sovereignty issue. No, I would block this. We don't even have to discuss. So
yeah, Trevor Hilder remarks that France seems to lack pension funds in the same way that we have in the Anglo world. Does that change your views at all, or how do you view that?
You mean regarding the lack of pension funds?
Yeah, the structured pension fund that we see as typical here in the UK, US, and Canada.
Absolutely. If we had pension funds in France, I don't think we will have the same discussions. I remember in 2013, 14, we also had the issue with General Electric, who bought, the power branch of Alstom, which still exists, but as a transport company, building trains and stuff like this. But by the time they were also, in the in energy and power sector, and we had a very large French investor, which is Bouygues, who wanted to sell, their equity investment in Alstom. It was around 4 billion, if my memory is correct. But we had nobody, no investor in France willing to commit, to buy these 4 billions. So then you don't have to be amazed if you have another company coming from abroad, and buying this. I know that there are also industrial synergies and other drivers for sure, but I think that the biggest issue for countries like France is that we don't have long-term investments, and pension fund it's like a bad word, bad buzz, because you have workers and you have guys from the left or extreme left that think that pension funds are bad and they are evil and that they will pressure companies. So you cannot even use the word pension funds. It's taboo. But I think it's a
now I'm going to wrap a couple together here. John Spain agrees with you that for long-term projects, accounting by reference to the discount process is inappropriate. One number is completely useless. So your proposal to consider the discount rate, he has some sympathy with. We then have Christopher Gleadle pointing out that there are many investment opportunities available today that focus on the integration of diverse technologies that are already available to accelerate action on climate and social issues, and they have a lower starting footprint and perform stronger over the long term. Do you see attention improving towards these solutions, and that they could please impatient investors? And very finally, I might tuck in here. Matthew Leach is curious about what types of projects towards sustainability must unavoidably be structured as years of net expenditure before there is any prospect of net cash inflows. So, a lot of tensions here on the timing and the integration of diverse technologies.
Yes, you are absolutely right. I think that we also have an issue. It's true that the price, of renewable energy is going down, and it's a good news. But I think that the problem with sustainable finance today is that it's quite binary. We focus on either pure players which are completely green, or we focus on punishing and divesting from brown and bad companies. So what about the spectrum and the continuum between the two? You have a lot of companies that are willing to transition, and I think that sustainable finance must help them with instruments like policy performance bonds, but these are probably not the only instruments that could help. And regarding your question about green technology, it was also one of the drivers that led us with Michael, to publish this book and push such an idea, because if you have uncertainty, regarding the price, for example, of energy or CO2, it's very complicated for you as a private investor, to take these risks and not to share them. So we think that governments, sovereign, must help in this regard, and you can imagine also a lot of different, even securitization. You can imagine some maybe quite complex instruments where you can have, like for pharmaceutical companies, structures, SPVs, special purpose vehicles, where you can have a pool of many different green technologies, and that if one of them is successful, you can have a great payoff, a great coupon on the other side of your balance sheet. So why not, structure such pools and special purpose vehicles, to encourage green technology. I didn't get the final question, Michael, regarding cash flows. I don't know if.
It's a kind of complicated. I'll send you the link after. Just have time for two quick questions. Well, they're all big questions, but we have an impatient audience, I think. John Spain actually comments back to say that UK pension funds of late seem to be moving away from patient investment, so maybe not quite as rosy a comparison as it used to be. Andrew Ross picks up on a point you just made, that sovereign and municipal bonds are usually investing in infrastructure, which stimulates long-term sustainable growth. So patient capital is related to that. And then sort of a pointed question along that same line. And here in the United Kingdom, back in, I think it was 2012, John Kay published a review of long-term patients, investing for the long term, which didn't really do very much, sadly, or at least that we can detect. And in fact, we ran a very large long finance conference on that subject back then. But basically, the first question is, again, from Bob McDowell: political perspectives within jurisdictions are generally short term. What influence do you think that has on capital investment?
Yes, thanks for this question. It's a very important one. And as you know, I talked about this time perspective theory, and politicians also have their time perspective, and it's true that it's maybe one of the limitations of our democracies, even if our democracies are, I think, still functioning quite well, and that are exhibiting better results than other form of state organizations. But it's true that with media pressure, with the elections that can happen in 4 to 5 years, you're right. Your time perspective must be present oriented. You cannot do some long-term thinking, some perspective, and in the developed world, in our countries, in democracies, you don't see a lot of reports that will push you to 20, 30, or maybe 40 years or beyond. The only agencies that do this are agencies like CIA. CIA publish every 4 years, so now they will publish their next paper for the world, for example, in 2040. In France, we don't see a lot of this. I don't know if the UK you have the same problem, but you are completely right. The political perspectives are also shortening, and this could damage.
That's one of the great things about your idea. The sovereign bonds would force those policies to be longer. And as I frequently said, our problem in the West is not making decisions. We get up every day and make a new one. The question is sticking to them in many ways. Yeah. And then just very finally, it will squeeze us in. Couple of comments here, Hugo, Bob, and others, but basically about technology companies. And those which have got a very heavy reliance on non-tangible assets, which, as you look at the tech giants and realize that virtually all of them have emerged in the last 2 decades, they have a heavy reliance on non-tangible assets and are more susceptible to volatility driven by technology advances, which creates more short-term focus on performance. So, given all of this new tech required, what are the incentives for entrepreneurs going forward? So just sort of curious how you feel about the technology world, which does seem to be driving many perceptions of returns.
It's a very interesting question. I think about Jeff Bezos, and Amazon. Why? Because I think that a part of his genius is that he helped to convince financial markets that classic financial performance is not a good metric. The good metric is growth, growth, growth at all costs. And then you have, as you know, the winners takes it all. So even if he didn't show any profit, any profitability during almost 15 years, he succeeded in convincing markets that you have to see other metrics, and this is maybe linked to the platforms and not all technologies, but let's say that you have a specific, patient, maybe capital and entrepreneurial, finance that is linked to such companies and that is not, pushing and putting some pressures on classic, performance, return on equity stories. I remember, hearing the French CEO of Carrefour, the French company I mentioned just before, and he was saying, and it's amazing because I don't know if it's the same in the UK, but in all economic conferences and financial conferences in France, you would have the word Amazon that will pop up at a moment or another. So Bompard, the CEO of Carrefour, said, Bezos is a genius because he built an equity story and he convinced financial markets, and he's a genius for that classic financial performance is not the good metric. So you have counter examples, I think.
Yeah, I think you do, and I also agree with you. We've seen some interesting elements in that where Bezos has invested heavily in space and Blue Origin, so he's definitely taking a long-term view, as has Elon Musk and others. So we have this bit where the individuals seem to have a richer view. What you seriously convinced me of, Djellil, is we should be almost putting on our classic dashboard of how healthy our financial markets, the time perceptions, both on equity and trading, and also on bonds and their issuance. And I think that's a deep indicator of health that we often skip over or only look at in presentations like this. But sadly, we've come to the end of time, which is great. It's so kind of you to dial in from Spain today. And what I was going to do, if I could, is just to give 3 quick rounds of thanks, as ever, to our sponsors, all of whom are interested in technology and investment. So absolutely delighted that they've allowed us to have today's seminar with you. I'd also like to thank the audience. It's a technical subject in many ways, and you've risen to the occasion as ever. I'm always impressed with the FS Club audience out there. We have a pretty full week this week with a webinar every single day. Tomorrow, an absolutely fascinating one, almost fully booked really, on the psychology of leading a hybrid workforce, which I think is going to be very important post-pandemic, post-vaccination, what have you. And going on, and then next week, another view from the continent on EU insurance mutuals dialing in from Brussels. So some really fascinating stuff ahead. As ever, visit the website. But Djellil, my last round of thanks is clearly to you. You're a dear friend, and it's always been a delight working with you. I certainly would never have published a book in French if it hadn't been for you. So I thank you for that. Unfortunately,
Many thanks for having me.
I'm able to open the floodgates of applause in these formats, but I do have my Korean karmic clapper here, and I will use that to substitute for the audience applause, which I know is out there, and you've got many, many thanks coming in, all of which I will pass on to you. Thank you very much, Djellil.
Thank you all for your time also.